with Mark Minervini. This last section of the morning session is squats and reversal recoveries, page 303. This will last about half an hour. As a reminder, this afternoon or this evening, or perhaps your tomorrow morning, we will be doing a replay of this session at 6 p.m. Eastern. We'll have the room open 30 minutes beforehand, 5:30 p.m. Eastern time. Look forward to seeing you then. Any questions you are typing in there, as a reminder, please make sure you reference the page number first, and it will and should only be on sections referenced from today's session. With that said, let's get started with squats and reversal recoveries.
Okay, hello, we're back. 2020 Master Trader Program, Super Performance Workshop. Here with David Ryan, of course. So we're going to talk about today squats and reversal recoveries, or I shouldn't say today, during this section of today. We're going to talk about squats and reversal recoveries. And what I want to show you here is that what I see with a lot of traders is they are jumping the gun very quickly, and there's a lot of over trading. Now, of course, everybody is armed with the equivalent of a machine gun in their hands with this internet trading and their cell phones. And now what we see is a lot of over trading, too much trading, too much sensitivity. So again, I want to show you some examples of stocks that attempt breakouts. And sometimes, we showed you a lot of different charts and a lot of breakouts, and sometimes they don't come out clean on that first day. And just the opposite, they pull back and they reverse. And a lot of times, I know a lot of people will sell on that reversal, thinking that the trade's not working, or maybe over the next few days it comes in a little bit more after it reverses. And what I like to do is I like to give the stock a chance to stage what I call a reversal recovery, which just simply means it gets above that high of that squat day or that reversal day and closes above it, which is very bullish if it can do that, subsequent to it, the stock reversing and squatting. And here's the main point. When you go into a trade, you should have already decided and defined your risk. So you're risking X amount of dollars, X percentage that the stock would move down, and you're going to cut your loss, right? Okay, what happens is a lot of people do that, and they come up with a number, and then all of a sudden that plan goes out the window as soon as the stock, breaks out, comes back in, and can't move for a day or so, and next thing you know, they sell it, and then a few days later they look and the stock is taken off, and it ends up being a winner, and they wonder why they're not having super performance. So you want to stick with that original stop in the very beginning and let the stock either stop you out or prove you right or wrong. I've said this many times. Stock trading is about anticipating coming movements and then waiting to be proven right or wrong. Dave, as far as, when you enter a trade and you set that initial stop, we went over a whole bunch of violations that might get us to actually sell the stock before it hits the stop, or in my case, a lot of times I reduce unless there's a lot of violations. Are you giving it that stop in the beginning? And if the stock breaks out and then doesn't take right off that first day, are you going to just dump the stock and say it's not working?
No, you want to stick to your original stop. I mean, if it has extraordinary volume and maybe there's some news item that is very, very negative, then I would sell it out. But I think what is causing this, and and I do this too, is that in the past we used to, I'd look at weekly and daily charts. Now we can get interday charts, 5-minute charts, 1-minute charts, every tick type of charts. And I think we're looking at these things almost too closely. Before we started this session, I was looking through some examples of William O'Neill marking up charts. And he never really used daily charts. Every time you see him marking up a chart, or some examples from Investors Business Daily, it's all on weeklies. I don't think he ever looked at daily charts until I started looking at them and showing them to them when I came to William O'Neill and Company. So I think it's the problem of is we're looking at these things under a super microscope now and looking at every little tiny movement. But you gotta give it the original stop and just give it a little room before you sell that thing out.
Right. I couldn't agree anymore. I tell people get those intraday charts off your screen,
Yeah.
especially a 1 minute and even a 5 minute, any of the intraday charts. Get them off your screen. If you're trading, swing trading, and you're going to trade this type of style that I'm showing you here, you want to look at daily charts and make your decisions on those daily bars and weekly charts. The intraday is going to get you very sensitive, and you'll start. I mean, if you're day trading, that's a different story. But if you're swing trading, position trading, long-term investing, you want to use the daily chart. And in order to use the daily chart, you've got to let the daily chart close and see what happens over a number of days to get those bars. But I think investors are almost like junkies now, where they get those bars. On an intraday, you get a whole bunch of bars, so you get to make a bunch of decisions, and that's just looking for action. Let me show you a few things here and show you how this plays out in real life. So just backtracking a little bit here and going to show you there actually is a pivot point right here, right? So that right there is a buy point. That's a perfect VCP setting up, and that's a cheat area, right? Now it comes up to the old highs here and sets up a nice handle. So that just starts off with a cheat area and then ends up giving you that handle phase. But now look right here. This is where it breaks out. Let me get that tool again. And you see right here, I'm going to go just under it. It breaks out, right? And then you see it comes back in and closes in the mid of its range or back into the pivot. Now that you may think that's really negative and it didn't break out and it pulled back into the pivot. That's not a pivot failure. I wouldn't sell the stock for that reason. I would stick with my original stop. So let's just say our original stop is somewhere, let's say it's somewhere down here a little bit, all right? We'll just say it's a little bit below in that pivot, all right? So I would stick with that and let it stop me out. Now, I've made that decision already. You've already made the decision. You're willing to risk X. You stick with that. Now, if we started seeing violations pile up, that's a different story, but you're not going to see violations usually on one day. It's going to take a number of days to see 3 lower lows, closes below the 20, the 50, all the things that we talked about earlier, counting up days versus down days. That requires some price trading. So here you've got 1 day. Now, what I like to do is I like to wait and give the stock anywhere between several days to up to a couple weeks. Sometimes you might get the market just starts correcting and the stock holds back for a week or two. Usually you'll get if the stock is going to be successful, you'll get a reversal recovery within a number of days to a number of weeks. Usually within 2 weeks, it's usually before that even, but at the latest, it would be a week or two. So you can see here, 2 days later, look how it comes ripping back. I mean, it really comes back here, and I can use my little heart there for that. Love that action, right? That comes ripping back out of there, now that's perfect. That's absolutely a perfect reversal recovery. And you'd love to see volume. I mean, if you see volume coming through there, but this is bullish. Sometimes actually, I will add to my position if it's not away from the base. If it's still coming out of the base and maybe I didn't get a full position on, or I want to go overweight, that tells me that the stock is now able to recover that reversal. That's bullish, and I might even add to my position there. And then from there, it's the same thing, counting days, looking for natural reactions, tennis ball action. Nothing changes.
Yeah, and Mark, I would add that if you are buying the stock correctly coming out of a base, and you put your stop at 7% or 8%, even if a stock squats, it's probably not going to hit that 8% stop loss, and you're going to be fine, even as the stock squats and then turns and goes higher. So if you're buying a perfect base or a great base, you shouldn't be stopped out too much, even with a squat.
Right. If you're coming from these tight pivot points, so if this was to stop you out in that 1 day, it would probably look something like this. Yeah. And it would be a full engulfing outside day, taking out the low of the pivot. Now you've got maybe a little reason for concern if maybe that does that type of action even before it hits your stop and it's on heavy volume. But even then, I might not sell if it hadn't hit my stop yet. I'm really going to stick with that original stop in the very beginning because I've already made that decision. That's how much that I've decided to risk. So here's another one, another 2-day reversal recovery, Micron. Again, coming out of this little pivot right here, little cheat area. See, tries to come out. I know it's pretty small here, but you can see right here, and then closes almost down by the low, almost at the low of the day. So it looked, a little bit negative for that day. The next day, it has a close at the high of the day, and then it starts to come out from there. And you can see it looks really great. It comes out 1, 2, 3, 4, 5, 6 days in a row up. Natural reaction, tennis ball action. But if you got nervous here and you got knocked out just because it squatted, you would have missed that, of course. Take a look here. Here's YY Inc., symbol YY. Now, sometimes you'll get where you'll come out of a pivot that maybe is a little questionable, and it actually gets better. The chart gets better once it goes through that reversal, or maybe even it does pivot failure. It does have a pivot failure and it stops you out. So for instance, here you came out, little 2-day pivot, tries to come out, and then it closes right at the low. Now, this may have knocked you out this next day if that percentage was enough for where you set it. I would like to, technically these lows here are important once they break out of a pivot. But you see, then it comes back up, it tightens up, and it builds a it's almost like a tiny little cup with handle or tiny little cheat area, again, fractals. And then from there, you get the recovery. So if you're in here and you're holding 8 days later, you get the reversal recovery, and look, a very nice move. And from there, 1, 2, 3, 4, 5, 6 out of 7 days up, and makes a nice move. Now it sets up again, excuse me, sets up again here in another cheat area. See, tries to come out right here, squats, then 1, 2, 3, 4 days later, moves and recovers. Show you a few other examples here. So here's coming from a cheat, right? From a low cheat, actually. Coming from a low cheat. And again, look how this tries to come out and then comes all the way back down and closes near the low. Not on the low, but back in the lower end of the range. And that looks, that might look ominous to you, especially if you were looking at an intraday chart. This would probably look like a big base failure or something on the intraday, and you'd get knocked out. The very next day, boom, into new high ground, pulls in, fills in the range. The next day, close. You got 1, 2, 3, 4, 5 days up in a row. You get a natural reaction, tennis ball action, 55% in just 15 days. You might have been stopped out right here and missed that if you're getting a little too sensitive to the.
And I would say then in these examples, and I've seen a lot of examples where when they do squat, they recover pretty quickly. They don't keep on going down into the handle or down into the bottom of the base. They squat for 1 day and then they start recovering and start building.
I find the same. Yeah, I find the same thing, that you're going to know pretty quickly if it's going to recover. It usually happens in a couple days to a couple weeks at the most, and so pretty quickly. And like I said, you made that decision to risk that amount. And now, if you in fact, let's say you made a decision to risk whether 8% or it's a dollar amount, maybe it's $1,000, and then you find yourself, when the stock comes back in, getting pressured, where you feel emotional pressure to sell. Well, that means maybe not your stop is too tight. It might be percentage-wise fine, but your position size might be too big, and it's putting too much pressure on you, and you need the position size smaller so you can stay in the name. So again, that's also how you can sort of test yourself to see where your comfort level is. If you're getting pressure just because the stock pulls in and it's off a couple percent, then you're definitely trading too large. So here's another one. Vroom. We actually looked at this before, looking at the cheat area. You see how many of these breakouts will come out, and then they will come all the way back down to the low and close right at the low. And then the very next day, look, wham, it comes out strong. And then 1, 2, 3, 4, 5, 6 out of 7 days up. In 8 days, it goes up 40%. Imagine if you were stopped out here and then you sit there and watch it go up 40% in 8 days. So again, and now here's a perfect example. You go back, let's go back here and take a look right here as we come through this level. And this right here is a little cup with handle, IPO base, right? Comes up, sets up. Here's your pivot right over here. Let me get my my spotlight tool. And it tries to break out, and this one squats. Now, look, the next few days comes in, you would have got stopped out. So if you were buying it here, you would have got stopped out. And now, as we talked about before, you've got a reset, right? You've got a failure, and now you've got the reset, and you reset on the cheat area. So you got the handle over here. It didn't work. Then you got the cheat, and then there was no handle. So this one, I brought this one up because this was tricky. This was a tricky one. And I happened to be watching this stock as it went through all of this, and I had not traded it. It was a tricky one. I had not traded this stock, but I watched it the entire time that it did all this, and I thought that this was a pretty interesting some variations that it went through. Let me just get that out of there. So this was L3 Communications. I bought this back in '98, and this is a perfect example because this actually did go out, put an outside day. See here where it tries to come out, and I bought on this day right here, and then it came back in, but again, not enough to stop me out. And I hung in there a few more days, and it was back into new high ground. And you see again, just a few days, 3 days later, and see how great it comes out. When they do work, they usually come out strong. And this is sort of that last shakeout that shakes out those weak hands.
Yeah. Yeah, it's that recovery too. Again, they seem to, the ones where they do have the squat, the very next day, it seems like they start recovering. So you should give it, I mean, anytime when you're buying a stock and it starts breaking out and does something like this, give it more than just one day. I mean, at least give it the second day to see if it can start holding and turning higher.
Yeah, and if it doesn't, if it can't stabilize and it doesn't turn higher in a few days or a week or two, then you know the train's not coming in on schedule, and you know something's wrong, and you're probably going to start seeing violations at that point. You might get some three lower lows. You're watching for the violations, of course, during this period, but you'll know that the train is not coming in on schedule, and that's really all you need to know is whether things are coming in on schedule or not.
Yeah, and I think an important point that you said too, if you're feeling pressure, you probably bought too big of a position. And in most cases, when I'm buying my initial position, I'm not buying all on the first day. And so if you've got this huge position right off the first day, then you're probably buying too much. My buying is usually spaced out in those first 2 or 3 days as the stock starts going.
Right.
Without letting it get too far. In terms of from that buy point, I don't want to let it get too far, but you might just be buying way too much in that very first initial buy.
And I tend to go in pretty heavy on my first buy and then try to get that full position once things are working. Until things are working and I'm seeing some traction in my trading, then I'm usually taking smaller positions. But sometimes when I come in on a trade like this, where I come in a low cheat, I might come in with a smaller position, and then if we can build additional pivots like you did here, add to it and start pyramiding, as Dave said, but only within the base. Not once it comes out of the base and it gets extended, we're not chasing the stock. Right. We're buying it within the base. So you get a little low cheat here, right? And it comes out, it squats. Then it goes really tight. And this is actually improving. This is looking much better. It's giving that right side time to build. It comes out again and then squats again. Although not a real big squat. Generally a squat is 50% in its range, or no, this is probably like 60% in its range, or 40% down from the highs. It's still above the mid of the range, but I would still call that a squat. And then 2 days later, you recover pretty nicely. So you get a 2-day reversal recovery, a 5-day first, and then a 2-day. So this is just classic action where you could be actually adding to the position, and as it takes out those highs and recovers, that's telling you that, especially if it does it a couple times, that's really telling you that the stock is acting right.
Yeah, and Mark, one other thing, going back to when you're buying when a stock is coming out, I don't buy all my position right at the beginning. And intraday, I might buy 3 or 4 times. And so what you might start seeing is halfway through the day, the stock starts slipping. And at that point, maybe you hold off until the last hour and you see where it's starting to close. And if it's starting to squat, halfway through the day, you might have to take your foot off the pedal and just say, okay, wait, let me just see. I've got a third of a position bought, and let me see where this thing is going to be closing in the last hour or half an hour of the day. And if it starts moving back up and it has a really nice close, well, then you can add to it near the close and get that position. But you don't have to buy it all in the first 15 minutes of the day. You can do it over time as the stock starts moving during the day.
Yeah, two things. One, of course, not all of us, get to buy like 100,000 shares like Dave does, but
no, not even close.
Well, at least when you were running the mutual fund, they did.
Yeah, oh, yes, yeah.
That's a very expert technique to go in there and to pyramid in intraday. So again, if you're trading, a few hundred shares or even a few thousand shares, you're probably going to put your position on, as it moves to the pivot. But that is definitely something that I do as well, that I might buy the position, and then if I see it closing real strong and it hasn't gotten away too far from the buy point yet and it's still in the range, I might add to it, because that strong close is what I'm looking for. And a weak close, of course, squatting, I wouldn't want to buy into that. That's something that I'm going to want to wait, give it a few days now and see if it can recover. So I'm just going to show you a few more examples. This is just a classic. This was LinkedIn. I showed you a longer term chart of this before. And this is just looking at the daily of where it broke out here, really just coming out and then squatting in again. And then a few days later, recovers into new high ground. Again, just give it those few days. These, of course, aren't putting a whole lot of pressure. Some of these examples I'm showing, I haven't really put a whole lot of pressure and slipped in much, but that's how a lot of them play out. And a lot of them play out this way. This was Amazon. I bought Amazon, back in 1997, coming out of the IPO base. I mean, this is a perfect setup, and you can see nice and tight. But see, on that day, it comes out and it squats, and it actually is an outside day to the downside, which is negative, but wasn't enough to stop me out. And the very next day came ripping back. Then it squatted again on the next day, which I don't give a whole lot of weight to that. But I'm looking at these coming out of the pivot. But again, it did try to go into new high ground on this one. So you see here, let's go right here. So as it goes into new high ground, you see it tries to, and then it comes back in, reverses, and then look at the next day. Wham! Comes blasting off, and you get a big breakout here. And that's the beginning move. That's going into the first all-time highs after the initial public offering of a company that we all know now, Amazon, right? All right, let's see. So here's a recent, this is a stock that I just bought recently. And you can see it comes out here. I actually bought some off the low cheat right here. I can't remember if we added to it here, but I bought it right here off that low cheat. And you can see that all the volume dynamics, everything is perfect with this. You get a big base, a lot of nice tightening, nice VCP, finally comes way over here, and look how tight all this is. And you can see the volume is, look how volume is so low here. If you go back and you look at all this volume, the volume that's consistently the lowest is right in where it tightens up and it gives you a pivot point. And the second lowest is right here where it gives you the next pivot point. And then you can see the contrast where the only volume bars that are above average volume bars are all breakout bars. So these volume dynamics are perfect. And you can see we not only come to the low cheat, but then you set up a cheat area, come out, squat, and then 3 days later, boom, real strong reversal. And again, this went up 80% in just 13 days. Real nice move coming out of this big base, XPEL. Another one, GNRC. This is one this was pretty unique. The way, and this is a big reversal. Again, you can't see this really good on this chart. I know it's small, but you can see that when it comes into new high ground out of this big base, and it gets nice and tight on this right side, look at, there's a big reversal there. It really is a large reversal, but 10 days later, it recovers into new high ground. You get a natural reaction, and this made a really nice gain here. So I actually bought this. I can't remember if I traded out of it when it came back up here. I can't remember exactly how I traded this, but I think I traded out of this too early, and it was a mistake. If memory serves me, this was recently.
Yeah, this is an up-to-date chart for September of 2020.
Yeah,
Uh,
and
and-
this was. I actually started looking at this, Dave. After remember when you had the fires and you talked about
Oh, yeah.
the Generac generators, and I
Yes.
was watching this ever since then and waiting for it to set up. I guess how long ago was that? That was a while ago, right?
Well, yeah. I mean, the fire came through here in. I know the date, November 9th, 2018. And then the very next year, you don't see it on this. Well, you can see the part of it, but it made a great move in 2018. Sorry, 2019.
19, yeah.
And then built that nice big long base, and then came up and out of there. And a lot of this move was part of a lot of hurricanes coming through your area.
Yeah. Yeah. And like I said, you mentioned this with the generators back then, and it was on my mind ever since. And then when I saw it set up here, I knew what the company was right away.
Yeah, and the other thing too is almost every single example that you have shown is the very next day it starts recovering right back up. It's like almost that squat day is the low day, and it doesn't trade much lower, and it goes right up from there.
That's right. And so if the stock does squat and then it comes in maybe a day or two, then you have to start looking and counting. Are there 3 lower lows? You start looking for the violations. And if your violations start piling up, you might sell or reduce. Maybe you reduce, you cut it in half. But again, yeah, like Dave said, the ones that work out and some of these that we're showing here, they're holding up and they're getting on the move pretty quickly. Real quick, I wanted to show. This is a very old chart. It's like a Telescan chart or something from the 90s. But I had this in one of my model books. It was this was back when I was holding for some bigger moves at the time, particularly prior to the 90s. When I was in the 80s, I was really holding for the bigger moves. You just trading in and out was prohibitive. The commissions were so high, and you couldn't make very quick moves. You had to call the broker on a phone. It was just totally different trading dynamics. But this particular stock really, this was a big winner. AccuStaff, it was one of my biggest winners ever that I actually held for a big move. And it just had all the characteristics. You can see here, you got a little cheat area over here, but I actually bought it once it formed this little handle. And it came out, I know it's very small, but it did squat. The very next day went into new high ground. You had a reversal recovery. But look at how through the entire move, look at these pullbacks. It's just natural reaction, tennis ball action, one after the next, after the next, after the next. And this right here, where I sold, you don't see it in here, but it was a 50-day moving average. We'll talk about a few 50-day moving average sell rules later on. But I just simply, once I got at a profit at this, I just simply said to myself, when this closes below the 50-day, that's where I'm locking in my profit. I'm just going to get out and I'm just going to let it, I'm going to ride the 50-day. And this road, you can see from split adjusted about $4 all the way up to over 30 or so. As a matter of fact, I even pulled out my ticket at the time. This was my my brokerage ticket. I bought 1,000 shares. And see, again, the price was not $4. It's adjusted for splits. I bought it at 24 3/4 on 728.95. And of course, that was about $25,000 worth of stock. Yeah, really, this was a really, a big move for me and a nice impact on my portfolio.
That commission wasn't that bad. I mean, $25 for 1,000 shares.
Yeah, this was when discount commissions really started to. As a matter of fact, I opened my account at Pacific Brokerage because a friend of mine, I had been trading at Oldie Discount, which had $60 commissions, and a friend of mine said you could be paying less than half of that. And he said, I got this great place called Pacific Brokerage, and they have great execution. Anyway, long story short, I called there. I spoke with a gentleman by the name of Artie Tolandini. He ran the trade desk there. We ended up becoming, over years later, became very close friends. He passed away now, but it was a good friend of mine after I was doing business at this brokerage firm for a lot of years, placing my trades there. So we just wanted to real quick. This is a pretty brief session as far as the squats and the reversals. We wanted to show you the concept and to just get you to understand that you don't want to leave. You could leave some of them big winners on the table if you get knocked out a little too quickly and you're too sensitive on that first day or so of breakout. I know a lot of people ask me, well, if the stock doesn't have the volume on the first day, or it doesn't come out and close strong, and do you just sell it? No, I don't normally. I normally hold and I wait and I stick with that original stop. And the real lesson in this is to come up with a stop that can hold you in, and you can allow the stock to fluctuate normally. And you're not going to get knocked out unless the stock really gets itself into trouble technically, or it hits that percentage decline that you've deemed, is the line in the sand. Any closing comments, Dave? Because like I said, this is a short topic here, but just
I think what this teaches is that we just have to be patient. We shouldn't, just because it comes in on the day that you're first buying it, shouldn't knock you out, especially if it hasn't violated your stop point, which should be at at least 4%, if not 7% or 8%. And so it's just, again, patience. I think too many people are into the market and they want instant gratification. They want instant profits. And if you get to the point where you're reading charts extremely well, a lot of these things will start off right when you're buying them, but it's not always the case. And that's why Bill was so insightful to put a stop at 7-8%, because he knew that you can't time it exactly right every single time, and there's got to be some leeway for some fluctuation and for down days in the market and things like that. There's a lot of things that can happen, but you just got to give it a little bit more time than just one day.
Yeah, stocks fluctuate, and of course you're going to choke off that fluctuation with what makes mathematical sense, risk reward wise. But again, I like my trades to work out perfect too, and many of them do. But I'd say at least half of them or more that come through these pivot points don't, and they come back in, they squat, they reverse, they come in for a few days, they come back into the pivot a bit, and you might be at a loss. You might be at a 2, 3, 4% loss before it turns back up. That's part of it. So plan for that. Okay, so we're going to take a break. We'll be right back, and this was just a quick topic that we wanted to cover, and we'll see in a few.
Okay, guys, that is the squats and reversal recovery section. And that is the last section for the morning session of today, day 3 of the Master Trader Program. I will be leaving the room open for you to be able to continue typing questions in regarding today, day 3 sections only. Please reference the page number first. That's how Mark gets to see them. Otherwise, he'll just glaze right over them. And again, we will be back at 6 o'clock. Well, we'll open the room at 5:30 Eastern time, begin the presentation at 6 o'clock Eastern. Again, this is going to be 4 sections. It will be in order this afternoon, and having it be lasting about 4 hours, as you can tell, with the breaks in between as well. We hope you have enjoyed it. We look forward to seeing you later on today. Again, if you're not attending the evening session tomorrow morning, we will open the room at 8:30 Eastern time in the morning for the 9 o'clock start time of day 4 of the Master Trader Program. Just looking here at a few things. Bear with me one moment. And also, some of you may have noticed within the book, there was pages 349 to 361, a couple of pages there. That is going to be what gets reviewed on Monday. So on Monday, I know I'll hang out here for a few questions that I see. There's a lot of people typing a lot of things, hard for me to follow it all along. but I will stay here for a little bit, answer those questions. If there was a section that was skipped over, again, that's going to be discussed on Monday, which, taking a quick look, that should be right. The daily routine, page 351 to 356, and then putting it all together, 357 to 361. So 351 to 361, those pages, which actually we were up to right now, that will be on Monday, but we actually didn't skip any of that today, now that I'm looking at it. Okay, so let me just, questions are coming fast and furious. Will you replay the sessions of yes. Is there any new material later? No, Eden, it is the same presentation as this morning, replayed this evening for a repeat of day 3. Day 4 will be tomorrow on Sunday, the 22nd. Have a great weekend, Chris. We'll see you tomorrow. Good. You will have plenty of time to be able to ask questions Monday. Yep. But type them in here if you do have questions. And, you know, Robert, you're a member of the private access service, so you have the ability to ask questions every week when we do the live Q&A every week about general strategy questions like that for Mark. Thank you, Kirby. All right. One thing, as of right now, Marius, the questions are looked to be answered on Monday. We'll let you know if there's any difference of that. Trying to just see if there's any quick questions here. Glad you had an excellent day, Daphne. Great. Yeah, Janaki. We'll be enabling you to type in questions later tonight as well. So definitely take this time in between the 2 sessions, review your notes is what I suggested earlier, and have that be something where you can definitely gather your thoughts and write down those questions later. Absolutely. Marius, yes, you know, Mark's strategy is all about being able to turn over his money, his inventory, as quickly as he can. So he is looking for more of the quick hits, as we call them in baseball terminology, singles and doubles, not really swinging for the fences to try to hit a home run. The longer term traders, investors, if you will, position holders looking to hold things for, you know, maybe a year or two, you know, maybe a minimum of 6 months, more like a David Ryan time frame is what more investor oriented trading's about. But we are swing traders looking just for a few weeks to a few months, get the quick hit, turn that money over again and again. As the expression is, wash, rinse, and repeat. And that's what allows one to achieve that super performance. Mark, and this is going to be reviewed even more detailed tomorrow with the risk management, by the way. General question, is Mark coming into a trade knowing what he wants to lose in dollars or percentage loss and then says his target should be at least twice that? No, it is 100% technical oriented. There is no such thing as fair value in our trading methodology. We're not fundamentalists. We're not value investors. We're purely technical traders with an overlay of fundamentals. So we always know what our average risk is per trade, and we're always seeking to achieve at least 2 times that. But it's not that he has necessarily a expected target price or a price target. You see in the selling section we just went through, a vast majority of what he uses in order to determine when it's time to sell. It's just analysis of reading, chart reading. You know, that's where we are excellent at reading price and volume. So that's to prevent you from putting an inhibitor in your thought process of where it is that you think a stock may go to, will cloud the analysis of just reading charts, reading price and volume each day. Nothing more needs to be done than that. Our average loss with our trading, and we have over 30 years of Mark's trading with thousands and thousands and thousands of trades to know that the average loss is somewhere between 4 to 6%. With our private access service that we've had, we're now just entering our 12th year with it, where we have also taken over 2,000 trades in from inception. Our average loss is below 5%, closer to 4%, over 2,000 trades. Just trying to see if there's any real quick general kind of questions, not page specific ones here that I can answer real quick. Nelson, the PE calculation is a trailing PE or a forward PE, or the PE updated each quarter? And the simple answer is it doesn't matter because we don't look at it, we don't care. But different, traditionally speaking, PE is relative to its trailing PE, trailing earnings. Although there is some integration of forward PE valuations that some strategies use, but we do not rely upon the PE. For a qualifier. That's more from a selling standpoint. You just, whatever it is that you used initially, if it's a trailing PE and it doubles, like Mark said, as a qualifier for looking at a time to see that the run has gone its a meaningful way, you just want to use the same qualifier. So that could be trailing, that could be forward, but just use the same qualifier. I should also just note, if you have typed your question, do not repeat it. Do not type it again. We are capturing all the questions, and all you're doing is making a lot more work for me. No, Kyle. The stages, once you have a stage 4, that's the downside of the mountain slope. Then you need to still go into, well, generally a stage 1 basing kind of period before you would start your stage transition to your stage 2. So not too often that you go down the mountain slope right back up into a stage 2. Does not happen typically that way. Doesn't mean it can't happen. Quick question some people were asking how to use the trend template on IPOs. Obviously, you're not going to have a 200-day moving average. You're not going to have a 150-day moving average. So you use what you do have. Maybe that's a 10-day or a 20-day or a 50-day if they're there. But keep in mind, guys, the moving averages is not so relevant. All that is a smoothing mechanism to see that we are in a trend, uptrend. Excuse me. Had to mute that one. Excuse me. But ultimately, it is where you're just going to use that price action, that assessment of price and volume. And as you saw, you definitely can see VCP action. You definitely can see low cheats or cheat setup. You can see tightening of price and drop off of volume. That's what you're really assessing. All the moving averages is just to help provide the bigger picture of the stock in a confirmed uptrend. But on an IPO, that's obviously of very little relevance. It's your chance to get on board. What would be one of the obviously a new traded stock to be able to play for the first time, and that's where you get a lot of excitement with a lot of IPOs, particularly high profile named ones. But you know, you can look at some of the classic. Facebook dropped nearly 50%, if I'm not mistaken, from 40 all the way down to the high teens. So you're not really just going to buy any IPO for any reason other than it meeting our VCP characteristics. Any reason Mark doesn't want to short much going into stage 3 and 4 seems like much of what his work identifies should apply. Not truly in a reverse or inverse is what it would appropriately be, Mark. It is something that there's a lot of reasons where shorting is not nearly as advantageous as going long. Namely, a limited downside, you can only go to 0. That's 100% gain, whereas from a long side, you can go up thousands of percent. It's also much faster. You have to be much quicker. And there's advantages to that, but there's disadvantages to that as well, particularly when you're dealing in size to be able to get in and out of a trade with size. The speed really does affect some of that. And also, it's just not something he ever really developed. The bull markets, bull months up versus months down. I mean, everything works towards the long side of the market as opposed to the short side of the market. If you're a short seller, you're limiting yourself to opportunities by nearly 2/3. So that's why would you focus on that when it's less time, less opportunity, and you have to be very quick on your reflexes. Doesn't mean you can't make money shorting. It's just not his bread and butter. He's going to go through screening on Monday, yes. Raphael, the largest update versus the widest spread or range is actually the better word to use, is similar, but keep in mind you could have a range on a daily chart, a daily price action that doesn't necessarily mean the stock's up. So just a little distinction there. biggest move up, but the range could be, an up or down, sort of a churning kind of day that doesn't end up with the stock being up. Just to be clear, Pierre, we don't run a model portfolio as part of the private access service. It's an idea generating service. So you will be managing your portfolio, but we're just going to provide a lot of trading opportunities using Mark's methodology, applying it to stocks that we can identify in the market. And what that means primarily means that we will have more ideas than you can have in your portfolio. So everybody's returns is going to be unique to themselves. If we have members who come on literally every single day. So with that said, if we had a model portfolio and we got fully invested a month ago or 2 months ago, that's not going to leave a lot of opportunity for people who are joining after the initial beginning of a new up move. So that's not really what the purpose of the service is for, isn't to achieve a maximum return. That's your goal, but the purpose of the service is to teach you how to fish, as we say, not just to be handing you the fish. So learning how to do this for yourself ultimately is what the service is all about while Mark is still doing it. We never know when Mark's going to decide to hang it up and move on to the next stage of life. So this is the purpose of the service, to provide you the knowledge, the tools, develop the skills and the discipline to be successful using his methodology. That's why he does the workshop. That's why he does the private access daily service. And you get through the learning curve, you should be in a position to fly the plane solo at that point. And, Mark's done his job in his mentoring and guiding you through that learning process. That is the whole point of what we're doing here every day. If we just wanted to provide profits and losses, we would just open a hedge fund, take everybody's money who asks us all the time to take over their managing their money for them, and we would just give them profits at the end of the year. That's not what is the motivation of the service at this point in Mark's career. It's to teach and educate, provide the knowledge that you'll be able to use, leave a legacy with that knowledge for future generations of traders to be able to benefit from that. I see the question here. Nicolette, why be so strict in your buying within 5 cents of an entry point if Mark is looking for a big move? I don't think he's ever said you had to buy within 5 cents. What he says is to buy within 1 to 2%. 1 to 2% could be a full dollar or $2, depending upon the price of your stock, could be $5 or $10 even. So it's 1%, not just 5 cents. Obviously, he's trying to buy it at the perfect point, which would be as close to that pivot point, just a single penny above it, to generate additional profit. Why give up 1% if you can capture that 1%? And 1% additional profit on every winning trade is a phenomenal difference on your performance. All you have to do is use one of our calculators that we have on the website for our members, what is called the RBAF calculator, and you can toggle and play around with different numbers to see exactly how that will affect one's return over a period of time. So 1% move is huge. When you're doing it 100 times over a year, do it every year, do that for 5, 10, 20 years. It's unbelievable. Ryan, Mark can sit out of the market as long as he takes until he finds stocks that meet his criteria. So if you have been around long enough, you may know about 2000, 2002 was a 3-year long bear market. And I can tell you there was Probably not even a single handful of trades taken in those 3 years. Actually, he retired at that time, actually, so he wasn't even really looking to trade. He knew that was called the bubble, called the top, went on TV on a regular basis and called for stocks to be dropping 50 to 80%. And that's exactly what not only stocks did that, but the entire market did that. Individual stocks often went down even more than that, 90, 95%. So he knew that was going to take quite a while for that to reset. And that was the bubble of all bubbles in this generation, that's for sure. So he retired, didn't even look at the market for a good 2 years, and not until really 2003, almost 3 full years later, was he then looking to kind of get back into stocks. But with the amount of money one could have made leading up to that point, can carry you for that period of time, and that's a very rare circumstance. Doesn't mean the market can't go through that type of circumstance again, but bear markets on average last about a year to 18 months, 9 months to 18 months or so. So, a year could certainly happen. Doesn't mean there's not a single trade to be trading at all, but it just means the risk to aggravation, as Mark likes to call it, it's just not worth it. You'll be fighting for just nickels and dimes, hard penny environment, we call it, not just waiting for easy dollars. And, that's what we're trying to find, easy dollars. And they are there to be had when the market meets, the conditions best suited for that. Fred, Mark's not going to go through a whole lot of detail of the private access service because that's not really the purpose of you paying $5,000 to attend this workshop. Isn't for us to be kind of selling and promoting and pushing our other product. It really is something Mark tries to avoid doing, in fact. So if you have questions regarding it, best for me to give you a call or you give me a call. Let me just write down your name here so then I can do that because it's not going to be really focused upon as a rule. Yeah, Mark, selling is all part of the risk management. I mean, this was selling into strength that you saw today. Selling into weakness or setting stops is all part of the risk management. Separately, position sizing also is part of the risk management. Position sizing is fully detailed tomorrow. Let's see something here. Yep. Jose, average win. George, what is his average gain? Not sure I understand the question. Mark's average gain is consistent with his entire career. It's somewhere in the 10 to 15% range. Probably something around 12%. When he was having his big up years, including winning the U.S. Investing Championship, his average gain was right around 15%. Steve, what is the average time Mark stays on a loser that hasn't hit his stop or violated any rules? Well, there is a thing called a time stop. that you could use as well as a price stop. But our average loser for the service, to give you an example, is just about 3 weeks, about 2.5, 3 weeks. So you're not going to sit there very long if a stock isn't going, or as Mark refers to it, the train isn't coming in on time. So we're not going to want to sit there too long in a name that's just sitting with dead money particularly when there are a lot of other names that are setting up and breaking out and working. So we're not going to want to have our money locked up in names uh, too long for that reason. So but time stops, again, might be a little quicker if it turns out that the markets are hot and moving and the names you're in aren't. So maybe lighten up or sell outright is a decision you'll have to make. But Raju, which Minervini book has this concept of lower lows? Well, I think both of his books talks about lower lows, but most definitely Trade Like a Stock Market Wizard in the risk management. The last two chapters of risk management definitely goes into lower lows. But also, I believe the selling chapter in Think and Trade Like Think and Trade Like a Champion. Yep, book 2, part 2, is where Mark also talks about what would be the violations of his selling, which we're going to get into more tomorrow. And that's where lower lows, 3 lower lows, is one of those violations. Francisco, the climax run of a power play is the same as any climax run of any trade. Yeah. Well, keep in mind, over the last 11 years, we've had up years, down years, and sideways years. So keeping that in mind, it's a little bit awkward just to use a calendar year as your barometer of what your average gain, average loss is. You really want to do it on a market cycle, a bull market to the next bull market. And as you go from the market cycles is really how you would want to measure your performance. If you identify those dates, track your results from that start date to the end of the cycle is really how one would do it best. But over 11 years, our average loss, like I mentioned, is somewhere in the 4% range, and our risk reward ratio consistently is over that 2-to-1. So just about 2.05 to 1. So we're maintaining that 2-to-1 over thousands of trades over a decade of trading. Again, consistently through all market conditions. No format for the trading journal. It's really just to take note of each trade, what your thoughts, what your feelings are, all parts of the trade. When you were buying, what were you thinking? When you were selling, what were you thinking? When you were making those decisions, just kind of journal your thoughts or your feelings. And when you go back and review that, when you do some of your post-trade analysis, it's amazing how, of course, the emotions are removed at that point. You'll see how much more involved you were emotionally with the trade than when you look back a month or 2 months later, and you just look at the facts, which is the trade chart itself for what it is without that emotion. But if you read your journal and you see what you were feeling, what you're thinking, what you're worried about, what you're excited about, you will see amazing analysis and self-awareness. The charting software Mark uses is Z-Signal, but he has it look and has them it mimic the look of the Marcus Smith charts. You're welcome, Dean. No questions to be answered today, Talal. We're just taking all your questions today. We are done for the day, Wisdom. Just hanging out here for allowing people to type some extra questions in, answering some general questions. Harrison, I have a few platforms, a few brokers actually, but it really is personal preference. It really doesn't matter what Mark uses, what I use, what Mark Rich uses. Particularly our international audience is going to have different needs or requirements. If you're a mobile trader using your phone, then the mobile app is going to be more important to make your decision, perhaps. I'm in front of my computers all day, and I have a pretty wide array of monitors here and things of that nature. So for me, the mobile app is irrelevant. So it's really a personal preference. Cost of commissions anymore is virtually nothing here, at least in the States. And, so commission structure has long gone out the window. That used to be one of the primary factors in one's decision making. All right, Keith, I will send you an email or give you a call. Well, not sure how many monitors you have, Jim, but let her know it's hopefully making you a lot of money, more than pays for itself. What is the marginal gain of an extra screen in your office? Interesting question. That's only something, again, depending upon your process and your brain and your eyeballs. I like having a lot of kind of call it real estate, so I can have a lot of charts up, and works for me. If you took a trade, Anthony, from entry point to exit point, shaken out 3 times over, it is 3 trades, yes. Now, if you had a position, you added to it, you got shaken out of that added shares, but you still have your original core position on, then you added shares again, got stopped out of those added shares again, you added again, stopped out of those average shares again. If only that was the case, that would be all one trade. But if you, from the point that you open a trade to the point where you have no more shares in that trade, that is a completed trade in our eyes. If you're adding, reducing, adding, reducing, adding, reducing along the way, that's all considered one trade for us. No, Randall, that is the average loss per trade, around 4%. You would have to have your entire portfolio fully invested and all being stopped to have a drawdown of 4% in that example. Yeah, not quite, Charlie. That's just the picture. It may look all fancy, but not necessary. Francisco on Monday will be covering the next 10 pages, 351 to 361. When we start tomorrow, it will be on risk management, starting on page 362. Todd, what does my trading setup look like? Number of screens, open charts for each position, and the optimal suggestions. Yeah, sort of same question. Got to find out what works for you. I do have my primary just being a daily, weekly, monthly, as well as an intraday. So I do have the 4 time zones, but keep in mind, I do a lot of day trading as well as swing trading. But always still look at the longer, larger time frame. So that's always important, even on day trades. And that's what my primary is for whatever stock I'm focused on. But then I have little thumbnail charts on any of my open positions that allows me just to very quickly be able to see visually on a chart as opposed to just a price watch list. What those are doing on a little thumbnail chart. And then you just have a series of watch lists of names that are, what you're watching. Have some alerts on there to trigger if you hit certain price levels. Pat, the information from the private access service is through the trading day. So basically 9 a.m. to 4 p.m. Absolutely. All buy recommendations, all sell recommendations, all trade management in between. Risk management, exactly where to set your stops. College trading has been good this year. All right, Bob, got to get you in there. No, we went to cash, Michael, for 401k long-term money back in the spring as well. Mark does share his long-term models as well each week. Keep in mind that doesn't really change too much from week to week. That is the whole point of a long-term model, is it kind of keeps you in the market and doesn't get you wiggled in and out or head faked the way you might be from a shorter term, intermediate term swing trading type of perspective. Nope, James, he does not. Nope, we don't do anything on the weekends for private access, purely the trading days. The actual print above the pivot point is the entry point, not a offer, not an offer price. Doesn't have to be necessarily a bid price. Just has to print. Actually trade at a price above the pivot. Yep, I know. Doug, I'm glad to see that you're getting through it. Just joined yesterday. Okay, gonna wrap up here, guys. I see I've caught up to the bottom with all the last questions here being typed that I'm going to be able to answer. All these other questions are going to be ones that Mark will be having to answer because they're referring to specific page numbers. That's great, right? 46% is nothing to be worried about. It's been a tough little month or two here. So you can see some of the performances of the 2020 US Investing Championship. They did drop in the month of October from the September results. So, you know, it's going to happen. Just got to watch, though, the amount of drawdown you're giving up there. You don't want that to be too much that you may get yourself into too much trouble if things continue to be challenging, that you're giving back too much when you're having some of your more challenging trading times. Mark, your question about options is correct when things are working for you. However, of course, if you know anything about Mark Minervini, he doesn't worry about things working out the way you want them to. He is always worried about what things could be going against you, not work out for you. So when it comes to options, there's a lot more going against you than the benefit of the leverage going with you. Most notably, as well, there are a number of names and stocks that we trade that don't even offer options. So we tend to trade a little bit of the smaller mid cap type of names traditionally. This year in particular has been the year of the mega cap. So we're in a lot of mega cap names because that's what's working. But I can tell you our typical sweet spot is around $2 billion to $10 billion. There are names there that will only trade monthly options, not weekly. The spreads are um, very wide when you're talking about not liquid options. So you have really that working against you. Liquidity can be a real devastating process if you need to get out quickly with slippage. A lot of things besides, of course, having to get the right strike and the right expiration date. And on top of that, you're paying a premium, whereas you're making profits from the first penny that you buy equities. So what's the difference? Or why not do the equity? For one benefit only, leverage. Mark's a multi-millionaire without having to need to use options to achieve that. Maybe he would be a billionaire, but you know, a lot more going against you. Need I go on? Francisco, good question. Climax run might become another power play. That's true, but so what? We don't buy power plays just after they go up 100%. They have to meet entry criteria, set of criteria. So if you have a stock that goes up, you sell it, it becomes another power play. You may have another setup to buy, right? But what happens if it doesn't do that and it comes all the way back crashing down? I can show you plenty of examples of that happening as well. Ironically, the BVXV that Mark and Mark Ritchie talked about in the power play section today, if you go look at that stock today, that stock that went up 150% in just 6 days is today a $3 stock. It's gone down 95% of its value in 1, 2, 3, 4 months since. So was it smart to take the profit when you had it as it was getting into a climactic run? These are the things you'll learn why Mark's a very wealthy man. Not because he's greedy. He has rules to take profits when the profits are there to be had. That's what allows one to create true wealth in the stock market, not trying to get every dollar out of every trade. And that is what we call a golden nugget, which is the one thing we did not have the ability to take advantage of online versus in person. So our alumni would be knowing the reference of golden nuggets throughout the entire workshop is numerous, but for a lot of you, you just won't get that on the first run through. It's a lot of information, hard to really appreciate all that information to understand how important some of those key golden nuggets really are. Cameron, compounding is definitely discussed in the risk management. Compounding is the biggest advantage to achieving success using market strategy. Yeah, Harinder, it's the first tradable base. Stage one is not the first base, no. Stage one is just lumbering around dormant activity. Once you're in a stage two is when you start identifying the bases. Reef, we have the monthly tracker in the analytics section on the platform. That's how you track your results, your trades. Mark Ritchie, he's 40 something, early 40s. Well, keep in mind when you're asking the question about research, Isaac, it is not that relevant on the research other than your earnings, your fundamentals, which is your code 33. That's available, something as basic as Yahoo Finance for free. So it's not so much that one needs from the standpoint of research, although Mark does have a institutional research product which costs tens of thousands of dollars, not really for the everyday man, if you will, and that's not recommended for that reason, but it's not really necessary to have. There's Benzinga and Briefing as far as some news services. You have Twitter is a good source of news. We type in, you see a bunch of people typing stuff in there, but again, news is not so relevant for what we're doing. In fact, we tend to stay away from any of the outside noise because again, it's all going to be reflected on the chart. But earnings events and earnings reported and all that is all public information. You can find that on multiple sources. Yep. What's the difference between taking this class and reading Mark's books? Peter, have you read Mark's books? You're taking the class. You tell me what's the difference. I can tell you what my experience is for 10 years doing this, in addition to reading the books, is monumental in the amount of information you're getting here, the level of detail, the granular level of detail and nuances that you just can't write into a 20-page chapter of words. It's not even, quite frankly, it's night and day. The book is a great baseline, a great starting point, but that's about all it does for you. It can't possibly go into what detail that you hear Mark going through with David Ryan, Mark Ritchie over 30 hours of verbal communication. It's just night and day. Yeah, about 15% is Mark's historical average gain. A little less now because it's not what it used to be in the old days. You had to overcome the cost of commissions. You had to overcome some other fees that would require you to get to that kind of number. The spreads, the liquidity on the names that he was trading, also just your average risk wasn't as little as only 4, 5, 6% back in the day because you were dealing with stocks that had so many um, such wide spreads and such liquidity issues that now the markets have never been easier to trade. Cost of commissions is nothing. Spreads are pennies. So you can get a much tighter level of stops. So Mark was averaging much more, historically speaking, in the 6% range. So you needed to get to 12, 15% just to be double that. Now, with the liquidity and intraday charting and the cost of commissions being nothing, he's able to get out one of his losses much tighter so you're able to take your profits a little quicker, and therefore your average trade nowadays is probably more like 10 to 12, not needing to get to 15 anymore. And there's a lot more stocks that get up to 10 or 12 before they get to 15. So just again, now allows you to roll over and turn over your inventory rather over and over and over again. Well, Gibby, with the analytics section on the platform that you have access to, that is going to allow you to track your trade by trade distinctly, not just your quote unquote average of all your legs like the brokerage statement will do. That's the whole benefit. One of the benefits of the analytics section is being able to track your trade by trade as a whole. Ray, it definitely is what leads to overtrading. But adding and reducing all within one trade before you exit the trade entirely is what we call one trade. Look, if you're profitable doing it, then all the power to you. But as you and I have talked about, something you need to practice that discipline of not doing that. Maybe get a zapper. Anytime you go to touch the keyboard, you get zapped. Might work. Charlie, this has definitely been an abnormally good year, but it comes off the heels of any type of devastating sell-off like you experienced in the spring. That's what always is going to provide phenomenal opportunity, because when the market goes down, it takes down all stocks, not just the worst stocks. So the great stocks also go down, and those great stocks will be the ones that come back fast and furious. That therein lies opportunity for you to make money and create wealth. Use our skill sets to identify those names. Mark will go through selling on the risk management again into weakness. So you'll see tomorrow where Mark is selling, scaling out versus one full trade, one single trade. Thanks, Viva. It is the passion that we both have for answering questions, helping people do this. It's not so much driven by money as much as just the fulfillment one gets for helping you guys out. And that's why Mark does it too. People ask all the time, why does he do this? He's got plenty of money. He's still got a passion for it, and you want to benefit, help others benefit. Yeah. Well, you couldn't have gotten this from Mark 25 years ago, Charlie. So don't feel too bad. No, my hair is not blue, although might just be the natural light kind of hitting my brown hair. It's brown. Blue. No, James, we're not going to talk about that really at all. It's a very small detail with what we deal with. I don't rely upon Marcus Smith for earnings. So, Doug, if that helps answer the question, I know when a stock that I own is going to be reporting earnings, and I know then that day's activities is if it's before the market opens, I know it's directly related to the earnings, or if it's after that day's close, I know then the next day it's going to be. So I don't rely upon Marcus Smith for my earnings dates. Yeah, I thought you'd like that Zapper idea, Ray. Maybe some others. Maybe Mark should come out with a branded Zapper for over traders. Fabio is asking, what do we do when we go on vacation? It's kind of a personal question, Fabio. But you're asking if we go into cash. Yeah. I mean, I go on vacation and just have my stops in, and no matter where you are, pretty much with the phone, you can always still see your trades and see what's going on. But if you're worried about it that much, absolutely just go into cash and truly go on vacation. Get away. That's one of the reasons why you're going on vacation, to get a mental break and refresh, recharge. Yep. The average gain again is about, depending upon market conditions, about 4, 5, 6 weeks. on average. So we could take a trade and take a profit in 2 days. We could also take it in 2 or 3 months. So that averages out to, about 5 weeks, 6 weeks. This year it's definitely dropped because the market is very fast, very quick. Profits are being recognized very quickly. So this is the kind of circumstance that you adjust for the market conditions, and that's sort of the point. Our losses are also being taken much quicker. So things are not working out. They're breaking down and failing much quicker, or if they're not going when other stocks are, again, we may get out of the trade and just move on. But we try to give the trades as much chance for them to do what they're supposed to do without sort of jumping the gun. But without any doubt, our average hold for our winners this year is definitely under 4 weeks, about 3.5 weeks. Average loss is less than 2 weeks, only about 8 days, 1.5 weeks. Yeah, Jonathan, got to understand my day trading is all a derivative of my swing trading. So they're not really that unique from each other. Sometimes people call it trading around the core position, trading around your core. So a lot of my day trades are just around existing trades that I have, or maybe swing trades that I missed, but there's other opportunities on a smaller time frame to get on board them. But they're all going to always be meeting the criteria of the bigger time frames, such that it has to be a qualified name from a swing trade standpoint for me to be interested in trading it on a day trade. If you're purely looking at trades on intraday basis with thousands of options here in the United States to trade, you're going to find thousands of setups. How could you ever qualify that and put yourself in the best spot for success? Is because you have confirmation from the bigger time frames is how you do that. Nope, not on Twitter. Don't need to be. About half and half, Fabio. Half the time is a buy stop. Half the time is a buy now. It's all just part of the teaching process. And from a service standpoint, benefit for you guys, quite frankly. Mark's trading himself is always a buy now with an alert on his chart. So he's not ever putting an order in as a buy stop. He just has an alert. If he's there, sees it, it's buyable, he buys it. If it already moved too much, too fast, he's not going to chase. Wait for the next one. If you're good at trading, Charlie, at any level, you're going to be good at whatever level. So it's not that it can be more profitable or less profitable. It's just the fact it is whatever works best for you. But as again, you're turning the money over more often, you have more compounding benefit that works for you when things are going well, and that works against you when things are not going well. So but if you're a profitable trader or poker player for that matter, that's why you want to play as many of these hands as you can, as many trades as you can, because your expectancy is a positive expectancy. You're going to make money. All right, guys, just the last few questions here. Average win-loss ratio is 2-1, at least 2-1. You get back into a name that you sold previously when it sets up, when it meets your setup entry criteria. So we're looking for a new VCP, a new pivot point, a new setup. That's how you get back into a trade. We do go into a little bit of the how to do trade, sort of some of that adding back into positions that we sold in tomorrow's session during risk management. I don't think you'll have to worry, Peter, about Mark's VCP becoming a crowded trade. The cup with handle has been around for decades. That still works. And there's a lot more people who are familiar with and know about cup with handles, and that still works decades and decades and decades later versus, you know, what are certainly hundreds of thousands of people know about Mark's VCP, but one, that doesn't mean they're all using it properly and correctly. But knowing how many books we've sold and things of that nature, there's definitely, it's not millions. So there are tens of millions of people that know about cup with handles. Still works. Yeah, always needs to have a proper VCP, always needs to have a proper setup, always needs to have a tight pivot for it to qualify again. No, we're never buying below the breakout. Never buying below within the pivot. We're always buying the breakout of the pivot or a pullback buy. That's a slightly different technique, but we do breakouts 80% of the time. Pullback buys are about not even 20% of the time, maybe somewhere between 10 and 20. No, the cheat is below the base breakout, but not a pivot breakout. Again, a lot of information you're learning and getting. It's going to take multiple reads, reviews, go back to the books, read them again, watch some of the video tutorials on the platform as a member for this to really all sort of sink in and get absorbed. A lot of information. Thank you, Peter. I've been told that all my life. No, Francisco, you can ask Urusha whatever you want. But I don't know that they have the ability to do some of the programming that you may be wanting them to do. I think that was asked, Kevin, and answered after last weekend's sessions. You don't know the volume until the end of the day. That's true, but you can extrapolate it and or assess your position at the end of the day. If the volume isn't there, you can always lighten up. Doesn't have to come necessarily that day as well. It's something that Mark wants to see it within a couple days for sure, but doesn't have to be necessarily that exact day. Because within a couple days, it should be hitting the radar of the institutions that would be then getting on board, and that's what we are looking for. Okay, guys. Why would you want a screen for a squatting candle within a handle? Harinder? Yeah, why would you want a screen for that? That's a negative. That's not a positive. Why would you want to be finding that? All right, guys, I need to get a break. No, that's wrong, Harinder. You're already in a VCP. If you have a handle developed, that is a VCP cup with handle pattern, if you will. And there is no smaller time frame than the daily time frame that we would have determined that to be the handle that we're looking for it to break out from. So you're wanting to find a stock that has basically head faked popping out only to come right back into the base, that's again a negative, not a positive. I would maybe want to screen for that to avoid that name, but if I would have already found the name as it's developing the handle before the squat, so it's already on my radar. No, I'm not sure I understand your extremely low risk entry, what that means. If you have a stock that broke out, maybe it went up 5% and now it squats back to the base, how's that now providing a low risk entry? You got it, Toivu. All right. With that said, guys, let's take a break here. It is there's no knowledge of whether that's adding or subtracting necessarily to the quality of the setup. All I know is you're not going to buy until it does a reversal recovery. So that now means you need the stock to go up 5% before you can buy it. Now you just increased your risk or reduced your opportunity as a result. So not something I want to be searching for. It doesn't mean I won't buy it if it does do a reversal recovery, but it's not something I'm searching for. That's again, that's by itself, in and of itself, a squat is a negative price action. Not something I want to be finding. We'll be back just a few hours and we'll get going again with tonight's session. And if I don't see you then, we will see you tomorrow morning, same time, 8:30 Eastern time. The room will open and then start the presentation right at 9 o'clock in the morning, 9 a.m. Eastern time.